In 1932, a small Austrian town called Wurgel had a desperate problem. The Great Depression had destroyed employment. A third of the population was out of work. The municipal coffers were empty. Banks were not lending. The economy was paralyzed. The mayor, Michael Unterguggenberger, did something extraordinary. He issued his own currency. But not just any currency. This money lost value every month. To maintain its face value, you had to stick a stamp on it that cost 1% of its value. If you did not spend it quickly, your money shrank. The result was astonishing. People spent the currency as fast as possible to avoid losing value. Commerce surged. The town hall collected taxes. Streets were paved. A bridge was built. Trees were planted. Unemployment plummeted. The experiment lasted 13 months. 200 Austrian towns wanted to copy it. Then the central bank intervened and banned it. The monopoly on currency issuance is not to be touched. The idea that inspired Wurgel was 40 years old when it was tested there. Today it is over 100. And it has still never been given a real chance. In the previous episode we explored modern monetary theory, an idea that is trying to change the rules of the game right now. But the history of economics is full of ideas that could have changed the world and, for different reasons, did not. Today we are going to rescue 5 of those ideas. Not as historical curiosities, but as proposals that remain relevant. Some were defeated by politics. Others arrived too early. Some are being reinvented right now. In 1933, in the depths of the Great Depression, some of the most prestigious economists in the United States proposed something radical: prohibit banks from creating money. They called it the Chicago Plan. Its principal authors were Henry Simons and his colleague Frank Knight, both at the University of Chicago. Irving Fisher, one of the most important economists of the first half of the 20th century, became its most passionate advocate. To understand the proposal, you need to remember how banking works. As we saw in Part 3, when a bank makes a loan, it does not lend money it already has. It creates new money. It records a deposit in the borrower's account and, just like that, there is more money in the economy. The bank only needs to keep a fraction of deposits in reserve. This is fractional reserve banking, and it is the system we have used for centuries. The Chicago Plan proposed ending this. Banks would have to keep 100% of deposits in reserve. They could not lend more than they actually had. Money creation would be the exclusive monopoly of the state. What would this achieve? According to Fisher, 3 things. First, bank runs would be eliminated. If the bank holds all your money in reserve, it can never run out. Second, the boom and bust cycles caused by credit expansion and contraction would be eliminated. If banks do not create money, they cannot inflate bubbles. Third, public debt could be dramatically reduced, because the government would receive the profits from creating money instead of ceding them to private banks. Fisher presented the plan to Roosevelt. It had serious initial support. But the banking industry mobilized against it, and the plan was abandoned in favor of less radical reforms like deposit insurance and the separation of commercial and investment banking. The idea did not die. In 2012, 2 IMF economists, Yarmur Benes and Michael Kumhoff, published a study revisiting the Chicago Plan with modern models. They concluded that Fisher was right about almost everything. Debt reduction, elimination of bank runs, greater stability. The study generated debate, but no country has adopted the proposal. Why not? Because the current system benefits extraordinarily powerful institutions. And because changing the way money is created is probably the most radical economic reform imaginable. Let us return to Wurgel. The idea that inspired that experiment came from an extraordinarily original thinker, Silvio Gesell. Gesell was a German-Argentine merchant who lived between the 19th and 20th centuries. He was not an academic. He had no university degree in economics. But he observed something the academics overlooked: money has an unfair advantage over goods. His reasoning went like this. If you have wheat, you need to sell it before it rots. If you have shoes, they deteriorate over time. But if you have money, you can hold it indefinitely. Money does not rot. This gives whoever holds money a superior bargaining power. They can wait. Whoever holds goods cannot. Gesell proposed leveling the playing field. Create free money, Freigeld in German, that lost value over time. Money that rusted, like wheat and shoes. If you hold on to money, you lose. If you spend it or invest it, you avoid the loss. The result would be faster circulation, less hoarding, fewer crises caused by lack of demand. John Maynard Keynes, who did not often praise thinkers outside the academy, wrote in his general theory that the world would learn more from Gesell than from Marx. And that the idea of stamped money deserved to be taken seriously. The Wurgel experiment was the proof of concept. It worked spectacularly, but was banned before it could be evaluated over the long term. Today, Gesell's idea reappears in an unexpected context. When central banks impose negative interest rates, as the European Central Bank did starting in 2014, they are doing something similar, penalizing those who hoard money. The difference is that negative rates only affect banks and large depositors. Gesell's Freigeld would affect everyone. In July of 1944, delegates from 44 countries gathered at a hotel in Bretton Woods, New Hampshire, to design the post-war monetary system. There were two proposals on the table. The American one, presented by Harry Dexter White, was clear: the dollar would be the world's reference currency, backed by gold. All other countries would peg their currencies to the dollar. The British one, presented by John Maynard Keynes, was more ambitious. Keynes proposed creating an international currency called the Bancor. It would not be any country's currency. It would be a unit of account managed by an international clearinghouse. The Bancor solved a problem Keynes considered fundamental. In the Bretton Woods system, countries with trade deficits have to adjust, reduce spending, devalue, accept recession. But countries with surpluses have no symmetrical obligation. Germany or China can accumulate enormous surpluses indefinitely, forcing adjustment only on deficit countries. Keynes wanted symmetry. In his system, countries with persistent surpluses would also pay a penalty. They would be incentivized to increase their imports, invest abroad, and reduce the imbalance. Adjustment would be shared. The United States was in 1944 the world's largest creditor and exporter. It had no interest in a system that penalized surpluses. White's plan won. The dollar became the world's currency. The Bancor died before it was born. But the idea did not disappear entirely. When the Bretton Woods system collapsed in 1971, some economists returned to Keynes. When the 2008 crisis revealed global imbalances, the governor of the Bank of China explicitly cited the Bancor. And the IMF's special drawing rights are, in a way, a very limited version of the same idea. If the Bancor was money for the world, local currencies are money for the neighborhood. And they have spent decades demonstrating that another way of organizing exchange is possible. The logic is simple. When you spend €1 at a multinational supermarket chain, part of that money leaves your community immediately. It pays distant suppliers, international shareholders, headquarters in another country. When you spend a local currency, the money can only be used at local businesses. It circulates within the community. Each local euro is spent several times before it leaves. The longest-running example is the Swiss WIR. Created in 1934 by Swiss businesspeople inspired by Gesell, the WIR functions as a complementary currency among small and medium enterprises. Today it is used by more than 60,000 Swiss businesses. It does not seek to replace the franc. It works alongside it, facilitating credit and trade among businesses that would otherwise lack easy access to financing. In Bristol, England, the Bristol pound operated between 2012 and 2020. Local council taxes could be paid with it. Local merchants accepted it. The mayor collected part of his salary in Bristol pounds. It did not transform the city's economy, but it demonstrated that a local currency can work in a modern economy. In Fortaleza, Brazil, Banco Palmas created a community currency called the Palma in 1998. The Palmeiras neighborhood was so poor that conventional banks did not operate there. The local currency generated a circuit of credit and commerce that noticeably improved living conditions in the neighborhood. The model was replicated in more than 100 Brazilian communities. No local currency has proven to be an alternative to the monetary system. But all of them demonstrate something important: money is not just a technical instrument. It is a social tool that can be designed for specific objectives. The oldest idea on this list is also the most radical. Cancel debts. In ancient Mesopotamia, Sumerian kings periodically proclaimed a debt jubilee, a general cancellation of peasant debts to landowners. They did this not out of generosity, but for stability. When peasants became too indebted, they lost their land, became debt slaves, and stopped producing. The system ground to a halt. The jubilee reset the board. In the 21st century, economist Steve Keen has argued that we need a modern equivalent. Keen, one of the few economists who predicted the 2008 crisis, points out that the level of private debt in advanced economies is unsustainable. When private debt exceeds a certain threshold relative to GDP, the economy stagnates because households and businesses devote an ever larger share of income to paying interest instead of consuming or investing. Keen's proposal is a modern jubilee with a twist. Rather than penalizing those who have no debt, he proposes that the central bank create new money and distribute it equally to all citizens. Those who have debts must use it to pay them off. Those who have no debts keep it. The result is a massive debt reduction without anyone losing out. The obvious objection is moral hazard. If people know debts will be periodically cancelled, they will borrow irresponsibly. Keene responds that moral hazard already exists, but in reverse, banks lend irresponsibly because they know they will be bailed out. The bank bailouts of 2008 were a debt jubilee for creditors. What Keene proposes is one for debtors. All of these ideas share something. They were born from the observation that the monetary system is not neutral. It is not a technical mechanism that simply facilitates exchange. It is a structure of power that benefits some and disadvantages others. The Chicago Plan questioned the power of banks to create money. Freigeld questioned the privilege of those who hoard money over those who produce goods. The Bancor questioned the advantage of surplus countries over deficit ones. Local currencies questioned the drain of wealth from poor communities to rich ones. Jubilees questioned the asymmetry between debtors and creditors. None of these ideas prevailed. But all of them identified real problems that the conventional system does not solve well. And all of them keep appearing, in new forms, every time the system fails. Perhaps the most important lesson is not whether any of these ideas is the right solution. It is that the monetary system is not a law of nature. It is a human construction. And what humans build, humans can rebuild. 3 ideas to take away from this episode. First, the Chicago Plan and Gesell's Freigeld attack 2 pillars of the current system: the creation of money by private banks and the ability to hoard money at no cost. Both ideas have serious theoretical foundations and partial evidence in their favor, but they clash with enormous interests and have never been implemented at scale. Second, Keynes's Bancor would have created a more symmetrical international monetary system, where surplus countries shared the cost of adjustment. It was defeated by the power of the United States in 1944. The global imbalances Keynes wanted to prevent still exist 80 years later. Third, local currencies and debt jubilees demonstrate that the design of money is not fixed. It is a tool that can be adapted to different social objectives. What is missing is not ideas. What is missing is the political will to try them. We have traveled from the wheat fields of antiquity to cryptocurrencies, from Adam Smith to artificial intelligence. It is time to step back and ask, after everything we have learned, what does the future of the economy look like? Next time, the final episode. The farmer, the shoemaker, and the future.